In job order companies, we have companies like Walt Disney, and their product is they make movies. Nike, they make athletic shoes. Heritage Log Homes, they make homes made out of log. And DDB Advertising Agency, they're in advertising. So those are job order companies. In process manufacturing companies, we have Pepsi, which makes soft drinks. We have Alcoa, which makes aluminum. We have Intel, which makes computer chips. Apple makes the iPhone, and Hershey Foods makes chocolate bars. Cost accounting systems, they measure, they record, and report product costs. The two main types of cost accounting systems for manufacturing are the job order cost system and the process cost system. The job order cost system provides product costs for each quantity of product that is manufactured. Each quantity of product that is manufactured is called a job. Manufacturers that use a job order cost system are sometimes called job shops. Some examples are an apparel manufacturer such as Levi Strauss, or a guitar manufacturer like Washburn Guitars. Also think of job order cost systems as unique products that are made, as for example an airplane. We can look at Boeing. They make specific airplanes. We look at General Motors. They make specific vehicles, whether they're commercial or they're for the average consumer. And we're going to see how those job order cost systems differ from the process cost systems. So each quantity of the product that is manufactured is called a job. Manufacturers that use a job order cost system, they're called job shops as well. Sometimes they're called job shops. In a process cost system, they provide product costs for each manufacturing department or process. Process cost systems are often used by companies that manufacture units of a product that are indistinguishable from each other and are manufactured using a continuous production process. As an example, we can see oil refineries. We can see a paint company. We can see food processors and chemical processors. So that's why in a process cost system you had Pepsi, because all the products are identical to each other. You can also look at Kellogg's, and they make cereal. When they make cereal, they make it in the form of a process, so all the cereal is identical. A process manufacturer produces products that are indistinguishable from each other using a continuous production process. Just like in the example that I gave you of cereal, it is a continuous production process. And the cost accounting system used by process manufacturers is the process system, and known as the process cost system. Process and job order cost systems are similar in that each system records and summarizes product costs, classifies product costs as direct materials, direct labor, and factory overhead, allocates factory overhead costs to products, uses perpetual inventory system for materials, work in process, and finished goods. It provides useful product cost information for decision making. And when we compare job order and process cost, we have a work in process account. Okay, in the work in process account, you're going to have direct materials, direct labor, and factory overhead. And you're going to have a mixing aspect in the work in process account, and you're also going to have a packaging aspect in the work in process account. So for example, if our direct materials consist of milk, sugar, cream, what happens is that the work in process it goes through a mixing aspect in the process cost system. So we get milk, we get sugar, we get cream, and then it gets mixed in the work in process. And then what happens, it gets packaged, and what is the outcome? You have ice cream. Okay, so remember, direct materials, you have milk, you have cream, you have dairy, you have the work in process, which is to mix it, and then you package it, and ultimately what do you have in the package? You have the ice cream. Okay, so you're going to have direct labor, and you're going to have factory overhead. The direct labor is going to be related to the mixing aspect of it. And in the packaging department, you're also going to have direct labor, but you're also going to have factory overhead. So the manufacturing operations in job order cost systems involve, if we go back to week 1 and we try to focus on the guitars, that we needed wood for the guitar, and wood is the direct material for the guitar. Well, the cutting and the assembling aspect of it, when the employees cut the body and the neck of the guitar out of the wood, well, the employees have to assemble and finish the guitars. So what's going to happen is that this is going to be a work in process. Now, what are the product costs? Well, the product costs are direct materials, the direct labor, and the factory overhead. Now remember that the direct materials is an integral part and a significant portion of the total cost of the final product. The cost of wood used in the neck and body of the guitars is what makes up the direct material. The direct labor is the cost of employee wages that are an integral part of and a significant portion of the total cost of the final product. And the wages of the cutting and assembling of employees, make up the direct labor. Factory overhead are the costs other than direct materials and direct labor that are incurred in the manufacturing process. The cost of guitar strings, glue, sandpaper, buffing, compound, paint, salaries, and specifically salaries of production supervisors, janitorial salaries, and factory utilities. In inventories, we have materials, includes the cost of direct and indirect materials used to produce the guitars. You have the work in process, that includes the product cost of units that have entered the manufacturing process, but they have not yet been completed. For example, you can see the product cost of guitars for which the neck and body have been cut, but they haven't yet been assembled. And we have finished goods, that they include the cost of completed or finished products that have not been sold, and the product cost assigned to completed guitars that have not yet been sold yet. So if you try to, draw a mental picture of this process, look at the materials inventory. What materials should you have in the storeroom? Well, you're going to have wood, you're going to have guitar strings, you're going to have the guitar bridge, you're going to have some of the accessories, and then the work in process is going to be where you look at the direct labor and the factory overhead. And then in the finished goods, it's gonna be the warehouse with all the finished guitars. And from the warehouse, where do they go? Well, the guitars go to the music store where they're gonna get sold. So remember this, material storeroom, that's where you have the inventory of the raw materials, the wood for the guitars, the guitar bridge, and the accessories like the guitar strings. And then in that production process, the work in process, where it's going to get transformed, is where you have the direct labor and the factory overhead, where the cutting and the assembling takes place. And then it's going to go into the warehouse as a finished good, which is the finished guitar. And from the warehouse, it's going to go to the music store. Isn't that exciting, seeing the entire transformation process of the guitar? Now, when we look at materials, the materials account in the ledger is a controlling account. A separate account for each type of material is maintained in a subsidiary materials ledger. So you have the materials account in the general ledger, and a separate account for each type of material is maintained in the materials ledger. All right, so in the materials inventory, you may have which is the materials is going to be the controlling account, and then you may have, for example, maple, oak, and hickory, which are different types of woods. So you have wood, but you have maple, you have oak, and you have hickory. And in the work in process is going to be the controlling account, and then you're going to have like job 71, job 72, what could be assembling, one could be, the cutting aspect of it. The same way if you look at the ice cream, you're gonna have job 71 could be mixing the materials, mixing the milk, the sugar, and the cream, so you can make so you can have ice cream. And in the finished goods inventory, you're going to have, the guitars that are ready, which eventually are going to go into the music store. Just like for the ice cream, you're going to have the finished goods, you're going to have the ice cream in there, which they're eventually going to go to the supermarkets. Now, when we look at materials, we look at the receiving report and the invoice that are used to record the receipt of the merchandise and to control the payment of the purchased items. So a supplier invoice of $10,500, that could be receiving report number 196. So receiving report number 196 is a supplier invoice of $10,500. Okay. And then there's going to be a supplier invoice, a receiving report, which is going to go into the materials ledger account. And then those amounts are going to go to materials requisitions. A receiving report is prepared when materials that have been ordered are received and inspected. So you have the supplier invoice of $10,500, and you have the receiving report. That could mean that you ordered, let's say, 750 units of maple wood. If there are no discrepancies in the materials and in the receiving report and the invoice, a journal entry is made to record the purchase. So what occurs is that in the company, you have acquired materials, so your assets go up. So when assets go up, you need to debit the asset. So you have acquired materials, so you debit materials. And if you bought those materials on account, or you're going to pay them in the future, they're going to be accounts payable, so you're going to credit accounts payable. So that invoice represents that you're going to debit materials and you're going to credit accounts payable for $10,500. The storeroom is going to release materials to use in manufacturing when a materials requisition is received. A materials requisition for a job order, let's say that the job order is known as job order number 71, you're going to have a materials requisition, and it's going to consist of the requisition number. So let's say the requisition number is 672, the job number is 71. The description of the material is the wood, which is the maple wood. There's 200 issued at a unit price of $10. That's going to be a total amount of $2,000. So 200 units at $10 is $2,000. Okay. For direct materials, the quantities and amounts from the materials requisitions are posted to job cost sheets. The job cost sheets make up the work in process subsidiary. So if we look at job order number 71, if our balance, let's say as of the previous month, which is December the 1st, is $3,000, and now our direct materials is going to be $2,000, which are the 200 units of the maple wood at $10 is going to be $2,000. So we have our previous balance of $3,000 plus $2,000 more, which is for the quantities and amounts from the materials requisitions that are posted to job cost sheets. And a summary of the materials requisitions is used as a basis for the journal entry recording the materials used for the month. So we have work in process, we're going to debit that for $13,000, and then we credit materials because we had initially debited materials, and as a result of the fact that now those materials are in work in process, you're going to debit that for $13,000. When it relates to factory labor, that's when employees report for work. They may use clock cards and in and out cards or electronic badges to clock in. When employees work on an individual job, they use time tickets. Okay, so those time tickets are going to show the number of the time ticket, the employee's name on the time ticket, the date of the time ticket, and the work description. So if we look at the guitars and we say that this is time ticket is for the cutter, the work description is going to be cutting. And then it's going to have a start time. When did that employee start working? Well, the employee started at 8 a.m. and they finished by 12 p.m. They worked 4 hours at an hourly rate of $10. So for 4 hours at $10, that was $40. And then they also worked between 1 p.m. and 3 p.m. That's a total of 2 hours at an hourly rate of $10. Those 2 hours represent $20. So the total cost of that time ticket is $60. The $40 plus the $20 is $60. So in factory labor, you can have several time tickets. For, let's say, for a particular job, you have a time ticket that is for cutting. You can have another time ticket for the assembling, and so forth. Now, factory overhead costs come from a variety of sources, including the following. They come from indirect materials, which comes from a summary of materials requisition. Indirect labor, that comes from the salaries of production supervisors and the wage of other employees such as janitors. Factory power comes with the utility bills. Factory depreciation comes from accounting department data. So for example, if we look at the factory overhead cost and we look at the guitars that we incurred, $4,600 of overhead in December. There's $500 of materials that consisted of $200 of glue and $300 of sandpaper. Okay, so if our factory overhead is $4,600 and materials of the glue and the sandpaper are $300 and $200, that's $500. And then we have wages payable of $2,000, utilities payable of $900, and accumulated depreciation of $1,200. Factory overhead is going to be debited for $4,600, and you're going to be crediting everything that went into the factory overhead, and that would be the materials for $500, the wages payable for $2,000, the utilities payable for $900, and the accumulated depreciation for $1,200. That would add up to the $4,600 of the factory overhead cost. Now, when you allocate factory overhead, that's the process by which factory overhead or other costs are assigned to a cost object, such as a job, is called cost allocation. The factory overhead costs are allocated to jobs using a common measure related to each job. This measure is called an activity base, an allocation base, or an activity driver. So we have cost allocations and activity base. And factory overhead costs are normally allocated or applied to jobs using a predetermined factory overhead rate. The predetermined factory overhead rate is going to be computed as follows. Predetermined factory overhead is going to equal to a fraction, and you're going to have a numerator and you're going to have a denominator. So the numerator is going to be estimated total factory overhead costs, and it's going to be divided by the estimated activity base. So estimated total factory overhead cost is going to be the numerator, and then the denominator is going to be the estimated activity base. So when we look at predetermined factory overhead, let's assume that the guitar company estimates that the total factory overhead cost as $50,000 for the year, and that the activity base is 10,000 direct labor hours. Okay, so total factory overhead cost is $50,000 for the year, and the activity base is 10,000 of direct labor hours. So we look at our formula, predetermined factory overhead rate. The numerators are estimated total factory overhead cost divided by the estimated activity base. And what do we have? We have the 50,000 of factory overhead cost divided by the 10,000 of direct labor hours. And you're going to have $5 per direct labor hour. That's the predetermined factory overhead rate. Okay. And then you're going to apply that factory overhead to the time tickets. And the time tickets are going to be classified based on the job number, whether they're cutting or it's the assembly of the guitar, whether you're cutting the guitar, assembling the guitar. And then that's going to flow into the jobs in production, into the completed jobs. And it's very important to find that $5 per direct hour, because those $5 per direct hour is going to determine, well, what about if they work 350 hours cutting? Well, it's going to be 350 hours times $5. What about if they work 500 hours assembling them? Well, it's going to be 500 hours times the $5. So when we apply factory overhead using a factory overhead rate of $5 per direct labor hour, if, for example, if we look at direct labor hours, and we know that for example, for the cutting, they worked 350 hours. For the assembling, they worked 500. That's a total of 850 hours. However, they happen to have the same factory overhead rate of $5. But however, the cutter and the person that assembled the guitars, there's where you gotta look closely at the factory overhead that's applied, because you see it was 350 hours for cutting at $5. That gives you 1,750, and then it's $500 for assembling it at $5. That's $2,500. So then your total factory overhead applied would be the sum of the total hours at the factory overhead rate. It would be the 1,750 plus the 2,500. That would be 4,250. Okay, so you're working with the total number of direct labor hours. That's going to be 850, and the factory overhead applied is 4,250, which is the sum of the total direct labor hours for the cutting specialist and for the assembly process. And then the journal entry for that is work in process is going to have a debit, and factory overhead is going to have a credit. So work in process debit 4,250, factory overhead credit 4,250. And that's going to be equivalent to the factory overhead applied. The reason that you're debiting work in process and crediting the factory overhead is because you have to remember that you added the factory overhead that was applied for the 350 hours at $5 an hour, and then the 500 hours at $5 an hour. So the 350 hours at $5 was 1,750, and then the 500 was also at $5. It was 2,500. So when you add 1,750 and 2,500, you get 4,250. Now, if we take a closer look at a particular job, let's say that on a particular date, like let's say on December 26, 2017, Mr. Andrews spent 8 hours on job 72 at an hourly rate of $15 for a cost of $120. So that's the 8 hours at $15. A total of 500 hours was spent by all employees who worked on job 72 during December for a total cost of $7,500. Okay. So you look at the time tickets, and then you're able to see what took place with the assembling, and you're able to see that in December the job 72 was 500 hours, and it was a total cost of $7,500. And that you would enter it on the cost sheets. Now, when you apply factory overhead, the factory overhead account is increased. It is debited for the actual overhead cost incurred. It is decreased or credited for the applied overhead. And if the applied overhead is less than the actual overhead incurred, the debit balance is called an underapplied overhead or an underabsorbed factory overhead. So keep in mind that if the applied overhead is less than the actual overhead, then it's going to be an underapplied factory overhead. Okay. If the applied overhead is more than the actual overhead, it is a credit balance that is called overapplied factory overhead. So you currently now know how to determine underapplied factory overhead and overapplied factory overhead. So if the applied overhead is less than the actual overhead, it's underapplied, and if it's more than, it's overapplied. So the factory overhead account for in the case of the guitar company, it can have both underapplied and overapplied factory overhead. and you can see that those balances would just reduce or increase each particular aspect of it. Now, in work in process during the period, work in process is increased, debited for example, for direct materials cost, for direct labor cost, for applied factory overhead cost, and so forth. So at this point, I'm going to make a quick pause so we can remain focused now on the assignment that you have to complete for week 2, and we have to see how our readings and our response to discussion questions are going to be fulfilling these objectives. So we just were able to distinguish between job costing and process costing. Now remember, job costing are particular jobs, you can call them unique or exclusive jobs, as if you were to manufacture one airplane. And process costing are those that are the same or they're indistinguishable, and those you can look at them, like soft drinks, like Pepsi Cola, like cereal. And then we also focused on developing and using departmental overhead rates to allocate indirect costs. Then if we focus then on the assignments that you have for week 2, they're going to ask you to assess the type of costing system. Okay, so you do your readings, you read chapter 3 on job costing, and then you're going to read chapter 4 on activity-based costing, lean operations and the costs of quality, and of course watching this mini video lecture. So your first discussion question is compare and contrast job costing and process costing. Excellent. Your second discussion question is discuss the 4 basic steps to computing and using activity cost allocation rates. Excellent as well. And then in the third discussion question for week 2, it's going to say discuss leaning thinking and identify the 8 ways of traditional operations. So perfect. Once you do your readings for chapter 4, you're going to be able to provide a response to that discussion question, plus what I'm going to add in the video lecture. So your week 2 essay assignment is you're going to assess the type of costing system. So you're going to have you're going to be able to look at you're going to be able to create a table in Excel or in Microsoft Word. And when you create a table in Excel or Microsoft Word, what you want to do is you want to list the companies as rows and then create columns so you can classify them as either job costing or process costing. So for example, you're going to have 14 items here of companies that perform, that are it's either going to be a company that uses job costing or a company that uses process costing. So you have from 1 through 14, you're gonna list them in Excel, as rows, and then in the columns you can put job costing or process costing, so you can match the company to whether it's a job costing or whether it's a process costing. So in one you have janitorial services company. What is that? Is it a job costing or is it a process costing? A soup manufacturer, is it a job costing or is it a process costing? And so forth until you get to the 14th one. And then in part 2, you're going to analyze manufacturing overhead. So you're going to look at Smith Foundry's manufacturing overhead table that is found inside Blackboard. So that table is in there. So after examining the table that's inside Blackboard, you're going to prepare the calculations for the 4 major requirements that include predetermined manufacturing rate, allocated manufacturing overhead, and also the depreciation, taxes, and wages, and determination of over-allocated or under-allocated cost. Excellent. You're going to compute the predetermined manufacturing overhead rate, and then you're going to explain how much manufacturing overhead was allocated to jobs during the year. And then you want to discuss how much manufacturing overhead was incurred during the year, explain whether manufacturing overhead was under-allocated or over-allocated at the end of the year, and if yes, explain by how much. Also explain if there were the jobs overcosted or undercosted, if they were, explain by how much. And formulate a strategy that can contribute to optimizing performance while maintaining efficiency and effectiveness. This is really important because this is where you start seeing how you're going to be making managerial decisions as a management practitioner using accounting information. You see, when the different department heads get together and they have to report to to the executive board of a particular company, what they're doing is, the executive board, management, shareholders, they're looking at the financial statements and they're looking at the net income and they're comparing the net income to previous periods. So it's like peeling the onion, where did the net income come from? Well, it came from revenues and expenses. Well, why were there more revenues than expenses? What did we do in one period that we didn't do into another? And this is going in really deep into the company, into the actual operations, and seeing how materials are acquired, at what cost, and who do we need involved to work with the materials to transform them into a finished product. So this is where you really start seeing how the managerial decisions are made using accounting information, and more specifically managerial accounting, describing these different types of cost accounting methods. So this is really, really, really important for you, and it's only normal that you have to read it probably more than once, and read it and look at the PowerPoints that you have, and look at the video mini lectures so that you can, definitely understand it. So to also, to conclude, so that you have a good, you feel that you have a good, well-rounded knowledge about week 2, I want to also go over activity-based costing and activity-based management, so that this can conclude our week 2 lecture, and you have all the material that's going to fulfill the objectives for week number 2. So why and how do companies refine their cost allocation system? So companies are going to have the way that they allocate costs. So why would they want to refine them? Well, sometimes traditional systems are not accurate enough. Sometimes there's a cost distortion. Who can refine and benefit? Well, manufacturing companies, because they need to buy the raw materials, service companies, and governmental agencies. So who are the individuals or companies that can refine and benefit? Well, we look at them more as business entities. Manufacturing companies can refine and benefit, service companies, and governmental agencies. Now, there's an abbreviation, predetermined overhead rate, applied to every job produced in the plant. So the predetermined overhead rate, known as MOH, is equal to the total estimated manufacturing overhead divided by total estimated allocation base. All right, so let me try to make it more specific. So if I give you a plant-wide overhead rate example, if I say that the estimated manufacturing overhead rate for a year is $1 million, right? And the estimated allocation base for that is 62,500 direct labor hours, and the predetermined manufacturing overhead rate is $16 per direct labor hour. What happens is, based on that formula, you would get the $1 million of the estimated manufacturing overhead for the year, and you would divide it by the 62,500 direct labor hours. Okay, so that's what would take place in that case. That's how the formula would work. So there's some other conditions that need to be met for the departmental overhead rates. Do different departments have different amounts and types of manufacturing overhead costs? Well, we just saw in our previous example that the total plant-wide manufacturing overhead is 1 million. However, the matching department is, for example, 400,000 of the manufacturing overhead, and let's say that the assembly department is 600,000 of the manufacturing overhead. So those 1 million, that, and I told you matching, the matching department, but it's more of a machining department, that has, for example, $400,000 of the manufacturing overhead rate, and in the assembly department it has $600,000 of that manufacturing overhead. So if for example, if you have one direct labor hour in the machining department, and then you have 9 direct labor hours in the assembly department, you have a total of 10 direct labor hours. And then let's say we have 4 direct labor hours in the machining department, and then we have 6 direct labor hours in the assembly department. We have 10 direct labor hours. Okay, so each department is even though for the even though the plant-wide overhead is 1 million, you're going to look at that and you're going to divide it up into the department overheads. What each department has allocated for overhead. Now, do different products use the departments to a different extent? Well, we just saw how, there's different direct labor hours for the machining, and we have, different direct labor hours for the assembly aspect of it. Now, departmental overhead rates, they establish separate manufacturing overhead rates for each department. So, I mean, if we look at a fitness company, we can, refer to Life Fitness Company. They can establish one one overhead rate for their machining department and another one for the assembling department. Okay, so we can also look at the departmental overhead rates we can look at them in 4 steps. Step 1 is to estimate the total manufacturing overhead cost incurred in each department in the upcoming year. Then step 2 would be to select an allocation base for each department and estimate the total amount that will be used during the year. Step 3 would be to calculate the departmental overhead rates, which is going to be the total estimated department overhead cost pool divided by the estimated amount of the department allocation base, which is the formula that we saw. And then allocate some of the manufacturing overhead from each department to the individual jobs that use those departments. So the departmental overhead rate times the actual amount of departmental allocation based used by the job. So step 1, estimate the total manufacturing overhead cost incurred in each department in the upcoming year. Step 2, select an allocation base for each department. Step 3, calculate the departmental overhead rates. And step 4, allocate some of those manufacturing overhead from each department to the individual jobs that use those actual departments. So those 4 steps are actually, what we saw when we looked at the plant-wide overhead rate. We did total estimated manufacturing overhead rate divided by the total estimated allocation base. And then we got the 1 million, and we divided that by 62,500 direct labor hours. And then, we were able to determine, how many out of those 1 million, then we want to be able to determine how many, what is actually allocated to each specific department, which brings us to those 4 steps that we just saw. So if you look at the departmental overhead rates in step 1, that's where you get the machining department, the assembling department, and you have total departmental overhead cost pool. So, the machining department had 400,000, the assembly department had 600,000. That makes that 1 million plant-wide. All right. And then the machining department had 12,500 direct labor hours, and the assembly department had $50,000 of direct labor hours. And we just add that, and what do we get? The 62,500, which we had initially divided by 1 million. And so forth. If you get the machining department, there are $400,000 of overhead cost pool divided by the direct labor hours spent in the machining department. That's 400,000 divided by 12,500. You're going to get $32 per direct labor hour. And in the assembly department, you have a departmental overhead cost pool of 600,000. And then you're going to divide that by the 50,000 direct labor hours allocated to the assembly department, that gives you $12 per direct labor hour. And finally, in step 4, you have manufacturing overhead allocated to the jobs, departmental overhead rate times the actual amount of departmental allocation based used by the job. So this is going to contribute to your success in the week 2 essay assignment, where you have to do some of these computations and then analyze them and evaluate them and then explain and talk about some recommended strategies. So it's been a pleasure to produce this week 2 video lecture for you, and I definitely hope that you enjoy it. And remember, it helps a lot to read the chapter, watch the video lecture, and as you're watching the video lecture, go back and maybe read some more on any of the areas that you still want more clarification on. And I also invite you to put any other areas that you want to know more about. Put it in the discussion question and say, what if this step was taken, and so forth. So questions are always welcome. Thank you and good luck.